This video is review of Subaru's fiscal year 2025 first half financial review, the period from April 2024 to September 2024. Subaru is a Japanese automaker renowned for producing vehicles that combine durability, advanced engineering, and practicality. Popular models like the Outback, Forester, and Impreza cater to a wide range of drivers, from families to outdoor enthusiasts. Key points: the financial results for the first half of fiscal year 2025. Global production and consolidated unit sales fell below the levels of the previous fiscal year, but both revenue and operating profit recorded year-on-year increases. The outlook for the full year. Having assessed sales trends and inventory levels in overseas markets, both production and consolidated unit sales were revised to 950,000 units. In terms of operating profit, because the yen has been weaker than originally expected, and currency assumptions were revised, but after taking into consideration the decline in consolidated unit sales and an increase in U.S. sales incentives, the original forecast of 400 billion yen remained unchanged. Consolidated unit sales and complete cars production. In overseas markets, the competitive environment has become more intense, but retail sales in Japan and the main market of the U.S. performed well. However, due to the decline in the first quarter, consolidated unit sales came in at 450,000 units, down 20,000 units from the previous year. Production fell 18,000 units year-on-year to 475,000 units. Unit sales by market. Unit sales rose in the Japanese market. Despite a highly competitive environment in the U.S. market, sales incentives were controlled to a level below the industry average and have achieved retail sales in excess of previous year figures for 26 consecutive months. Because Subaru controlled wholesale units, which are equivalent to consolidated unit sales, relative to the increase in retail sales, Subaru has been able to maintain retailer inventory at levels that are among the lowest in the industry. Variance in operating profit. The factors driving the increase of 36.2 billion yen in operating profit. The main drivers were a gain on currency exchange of 72 billion yen, caused by the approximately 14 yen depreciation of the yen against the US dollar, and positive impacts from SG&A expenses, selling, general, and administrative expenses, and cost impacts of 5 billion yen and 3.9 billion yen, respectively. The main factor working to reduce profit was a deterioration in sales volume and mixture, etc., of 44.1 billion yen. Compared to the same period of the previous fiscal year, unit sales decreased, but revised selling prices for the new Forester made a positive contribution to profit. However, there was a negative impact on profit, driven mainly by a rise in total sales incentives of 43.1 billion yen, following a year-on-year increase of $1,000 in sales incentives per unit in the U.S. market to $1,900. Shareholder return. Interim dividend is 48 yen per share, in line with previous forecasts. Furthermore, the year-end dividend forecast is unchanged at 48 yen, making for an annual dividend of 96 yen. Dividend payout ratio of 23.4%. Only 23% of profits are allocated to dividends. Stock price. This is the Japanese yen-based chart for the last 1 year. The Japanese yen stock price is 2,784 yen as of January 7th, and the US dollar stock price is $8.83 as of January 6th. Current PBR is 0.8 and PER is 6.8. Dividend yield is 3.45%. Compared to the last few years, PBR, PER, and dividend yield show that the current stock price is relatively lower. Stock price is lower recently due to deteriorating business performance forecast. Conclusion. FY2025 full-year revenue is forecasted to be roughly the same compared to previous year, but operating profit and net profit are expected to decrease. Annual dividend amount will also be decreased to 96 yen from the previous year's 106 yen. Thanks to the weak yen, Subaru has been able to maintain their sales this fiscal year. But if the yen strengthens in the future, the situation is likely to become more difficult.